we calmly organize the movements of the world and the flow of the markets. This is Moonvale Atelier's economic analysis. Now, the global picture feels crowded with a lot of different signals. Middle East risk, higher oil, a stronger dollar, weaker equities, credit stress, sticky yields. And when all of those things hit at once, it becomes very easy to look for one dramatic breaking point. One country, one market, one instant crisis. But I think this shock makes more sense if we look at it a different way. Not as a single collapse, but as a global endurance race. Because what makes this environment so dangerous is not just the possibility of missing barrels. It is the way the Strait of Hormuz shock can wear down the system through insurance, freight, lead times, currencies, rates, and credit. In other words, the first thing to break may not be physical supply. It may be the cost, timing, and financing of getting energy and goods where they need to go. That is why this can feel less like one explosion and more like a drawn-out stress test. So that is the question I want to walk through today. How should we think about this as a global endurance race, centered on high US rates, credit stress, and the Strait of Hormuz shock? Today's structure is simple. First, what the real nature of this shock actually is. Second, why it turns into a global endurance race instead of a one-day collapse. Third, why even the United States is not a true safe zone. Fourth, how the main battlefield may shift over 3 months, 6 months, and 1 year. And fifth, where the real fracture points may be. Chapter 1. What is breaking first is not supply volume, but delivery itself. Let's start with the core point. A lot of people look at this and think, war risk rises, oil goes up, supply gets tighter. And that is not wrong, but it is incomplete. Because what may actually be breaking first is not total supply volume. It is the way supply reaches the market. If the Strait of Hormuz becomes less reliable, a whole chain starts to weaken. War risk insurance becomes more expensive. Freight rates rise. Escort and shipping constraints appear. Transit times become less predictable. And uncertainty rises faster than verified information. So the market does not only worry about whether oil exists. It worries about whether oil and goods can move safely, cheaply, and on time. That is a very different kind of stress. It means the first damage can appear in the delivery mechanism before it fully appears in the physical supply numbers. And that difference matters a lot. Chapter 2. That is why this becomes a war of attrition rather than a single crash. This is one of the most important parts of the whole story. If this were just a short and clean supply shock, then maybe we would get one sharp price move and then a reset. But that is not the structure here. Because once insurance, freight, currencies, and financing costs all start rising together, the pressure spreads slowly across the whole system. That is why this looks less like one dramatic break and more like a war of attrition. There are really 2 loops that matter. The first loop is the stagflation-style loop. Hormuz disruption leads to higher energy costs, which push inflation expectations higher, which keeps rates elevated, which hurts credit, which then weakens growth. The second loop is the dollar pressure loop. Risk-off flows support the dollar. Weaker importing currencies make inflation worse abroad. Policy flexibility shrinks. Growth weakens further, and credit stress deepens. And once both loops begin turning at the same time, the world starts wearing down in multiple places at once. Energy importers suffer from higher oil and a stronger dollar. Exporters may look safer at first, but if financial conditions stay tight, they do not get a free pass either. That is why this is not really about who wins instantly. It is about who can endure the longest, with the least damage. Chapter 3. Even the United States is not a true safe zone. Now let's talk about the US. America clearly has relative advantages here. It has stronger energy positioning than many peers. The dollar tends to benefit in risk-heavy periods. On the surface, that can make the US look like one of the better-placed players in this endurance race. But the problem is that America's strengths can also tighten conditions for everyone else, and eventually for itself. Higher oil can push inflation concerns back up. That can reduce room for rate cuts. Real rates can stay high. The dollar can remain firm. And the longer that happens, the more pressure builds in global and domestic credit channels. That is the contradiction. The US can be relatively stronger in energy and currency terms, while still becoming more fragile through finance. And that is why the center of gravity in this story still comes back to high US rates and credit markets. Especially the parts that are easier to miss: private credit, floating rate debt, commercial real estate refinancing, non-bank liquidity, and weaker funding structures below the surface. That is where a lot of the quiet damage can accumulate. Chapter 4. In 3 months, the battlefield is likely to be currencies, insurance, and short-term credit. Now let's shift to the time horizon. Over roughly the next 3 months, the main battlefield is likely to be import inflation, currencies, insurance costs, and short-term credit spreads. This is still the early endurance phase. It does not automatically mean global collapse, but it does mean someone has to absorb the extra cost. Households, firms, or governments. Somewhere in the system, the burden starts getting allocated. Importing currencies can weaken. Insurance and freight can stay elevated. The dollar can remain strong. And the market keeps asking the same question. Is this a temporary disruption, or the start of something more persistent? So at the 3-month stage, the key issue is not just price shock. It is whether the world can absorb the first round of wear and tear without deeper damage. Chapter 5. In 6 months, the battlefield may shift toward defaults, loan loss provisioning, and lending behavior. At around the 6-month point, the story can become much more uncomfortable. This is where the lagged effects of high rates and tighter credit begin to matter more than the initial energy shock itself. Companies face refinancing pressure. Margins get squeezed. Banks and non-banks become more cautious. Loan loss provisions can rise. Lending standards can tighten. That is when a price shock begins turning into a credit shock. And this stage matters because surface-level market stability can become misleading. Equities may still look more resilient than expected. But if the flow of credit underneath is weakening, the system is already becoming less flexible. That is when the real endurance test gets harder. Chapter 6. In 1 year, the battlefield may become supply chain redesign and fiscal erosion. If the stress lasts closer to a year, then the battlefield changes again. At that point, this is no longer just a market event. It becomes a structural adjustment story. Companies redesign sourcing, inventory strategies change, energy routes get reconsidered. Governments spend more on subsidies, defense, and stabilization measures. Interest costs remain heavy. Fiscal space erodes. That means the system starts adapting, not under the assumption that things will go back to normal soon, but under the assumption that the old normal is already gone. And once you get to that point, the phrase winner starts to lose meaning. Because even the relatively stronger countries are still paying a price through fiscal strain, higher funding costs, political pressure, and a more expensive cost of living. So the 1-year view is no longer about temporary shock absorption. It is about whether the global system has to redesign itself around a more hostile baseline. Chapter 7. What are the real fracture points we should watch? So where should we be looking most carefully? In my view, the real fracture points are not just the oil price itself. There are 4 things that matter most. First, the recovery or non-recovery of Hormuz transit, insurance conditions, and shipping security. If that mechanism does not normalize, the price shock can keep feeding back into broader financial stress again and again. Second, how far dollar strength pushes damage into importing currencies. That directly affects inflation, policy flexibility, and financial vulnerability outside the US. Third, how much high US rates erode the weaker parts of credit, especially private credit, commercial real estate refinancing, non-bank liquidity, and the less visible corners of funding markets. Fourth, whether the system starts showing signs of liquidity withdrawal rather than just price volatility. Gating, redemptions, markdowns, defaults, tighter lending behavior. That is the moment when the story stops being about repricing and starts becoming about impaired credit transmission. And if those fracture points begin to light up together, then this is no longer just an oil story. It is the full endurance race becoming visible. Closing. So let's bring it all together. This is not just a Middle East story, and it is not just an oil story. The Strait of Hormuz shock can damage the way energy and trade move through the system, and from there, the wear spreads through insurance, freight, currencies, rates, and credit. That is why this looks like a global endurance race. And right at the center of that race sits the combination of high US rates and credit market fragility. America may have relative strengths, but it can still wear down financially, even while looking stronger than others on the surface. Over 3 months, the stress may concentrate in currencies, insurance, and short-term credit. Over 6 months, it may shift into defaults, provisioning, and lending behavior. Over 1 year, it may become a story of supply chain redesign and fiscal erosion. So the key question is not, who wins immediately? The better question is, who starts wearing down first, and where? Because once you look at the world that way, moves in oil, the dollar, or yields stop looking like isolated charts. They start looking like progress markers in a much larger global endurance race. We should keep tracking it together.